Good morning, traders! Welcome to this Elliott Wave Street special webinar. I'm Juan Maldonado, and it's a pleasure to be with you today. We are live, and we are going to check some Elliott Wave basics and some examples that you are going to find a lot of value because the Elliott Wave theory is something that is going to change completely your life. So if you are completely new to the Elliott Wave theory, or if you have been trading a lot before with the Elliott Wave theory and you need a little bit more of help of understanding how to apply it, how to use it, you are in the right place. The analyzing the cycles is something that requires time, that requires experience, that requires good training in order to be successful in this project. Trading, of course, requires a lot of effort. So today we are going to check the basics of the Elliott Wave theory in order to provide you with tools to understand how it works, what is the useful part of the Elliott Wave theory, and how you can improve your trading immediately with these concepts. Here we have the Elliott Wave complete market cycle. So this Elliott Wave complete market cycle is the foundation of the wave theory, because the main plan when we are analyzing the markets with this approach is, first of all, the first step is finding where we are in this chart, because when a financial instrument starts trading, let's say the IPO, it can start anywhere in the cycle. Can start inside the wave 4, can start inside a wave at the top of wave 1, whatever. So of course, we need to understand that is extremely important to find the where we are. So that's the first step. We can use a monthly or a weekly chart to start checking where we are. The second important concept around the Elliott Wave theory is that we need to understand the personality of each leg, because each wave is going to come with a strategy. So understanding the cycles, understanding the personality of each wave, it's key. And of course, everything around the guidelines and rules of the theory. And with these three concepts, we can start working. So let's work today with the personality and some guidelines and rules of the Elliott Wave theory. The Elliott Wave theory says that the market cycles, or the price action in the markets, is fractal. Fractal means that we have cycles inside the cycles. As you can see, for this wave 1 that we have here, there is a 5-wave sequence inside. So we have 1, we have 2, we have 3, we have 4, and we have 5. A 5-wave sequence inside the wave 1. Then we have a wave 2, and we have a 3-wave sequence. So the numbers are going to be always for the impulse. The impulse is a 5-wave sequence, and we are going to use letters for the corrective waves. So from now on, always when you have an Elliott Wave analysis in front of you, you're going to find out if the actual cycle is impulsive or if it's corrective, depending if you see numbers or letters. Letters for corrective waves and numbers for impulsive waves. Let's continue with the fractal nature of the wave count. So inside each leg, we are going to have another impulse. Inside of an impulse, we are going to have an impulse. And then we have a corrective, and then we have another impulse. Notice that this cycle at the same time is showing the 1, 2, 3, 4, 5 sequence as well. So we have 5 waves where each leg is going to have its own 5 wave sequence, and at the same time, this 5 wave sequence in black circled 1, 2, 3, 4, and 5 at the same time is making a higher degree wave that we are calling wave 1. So we can say that the wave 1 in black, that will be this cycle here, from here to here, inside comes with 5 waves of this magenta or this pink color. And let's use any other color here. Inside each of the waves, inside the magenta or the pink color, we're going to have also 5 waves for its wave 1, the 3 waves, 5 waves for its wave 3, the 3 waves, and 5 waves for its wave 5. That's the fractal nature of the wave count. So of course, if we are on the weekly chart, we can go to the daily, then we can go to the 4-hour chart, we can go to the hourly chart, we can go to the 1-minute chart, and today we're going to check some examples doing that as well, moving to lower time frames. So when we have the completion of the wave 1, the cycle repeats. We have the ABC for the second wave, and then we expect the wave 3, and it repeats and repeats and repeats and repeats and repeats. So, and if you have any questions, the chat box is open. If you are watching the recording later, you can send us an email. Here is the email at the bottom, support@elliottwavestreet.com. Any questions, you can just send an email. Or type here if you're live in the webinar. So let's have a look at the structure of the waves. Let me hide the S&P here for a second, and let's talk about the basics of the waves. So when we have traders, the wave 1, the wave 2. Let me draw this here as first. During the wave 1, of course, before the price has been selling off. So the price sell-offs, you are trying to find the end of the trend, and eventually you start seeing a 5-wave sequence in the opposite direction. 1, 2, 3, 4, 5. Usually the beginner will start thinking, okay, that's my wave 1. So the wave 2 is coming, and the beginner starts having a bias of the wave count, and starts thinking that the market is going to build the wave 2, and then the price is going to move up. And that's a huge mistake, because when you have the 5-wave sequence, this is just the first step of the reversal in the Elliott Wave theory. The second part of the process is having a good quality of corrective wave. Because let's suppose that you start saying, okay, that's my wave 1, I have to buy because it's my wave 2, I have to do it, I have to trigger the trade. And when you are focused on that process, the price starts selling off strongly. Let's suppose that the price starts moving down fast. And you say, oh, That's fantastic. Is my second wave. I have to buy it. I have to go long. I have to start following the trend up. That's beautiful. But the problem, traders, with this concept is that when the price is moving down fast, is not a wave 2. So speed really matters. And this little advice is going to save you from hours and hours or probably years of frustration because a corrective wave that you are going to trade never should be fast. Never should be fast. The corrective wave always needs to be slow. So, after you have your 5-wave sequence for the wave 1, then you look for the ABC for your second wave. And after the second wave, that's where we can start building the wave 3. That's where we can start following the move up. That's where we can have an edge. The other important aspect about the second wave is that you need to clearly see a 3-wave sequence. You can label ABC. No problem, ABC. Remember, every wave has another set of waves inside. Corrective waves, at least 3 waves, an impulsive wave, 5 waves. ABC for the second wave is low. There you can use your indicators. If you like to use a MACD or an RSI or a stochastic, whatever, look for divergence between A and C. If you don't like to use indicators, just visually start checking the speed. We're going to check some exercises today, of course, in the real markets, but this is just the foundation. So a slow move down. The meaning behind the speed of the market is simple. When you have the price moving down is slowly, what is happening is that the price is trying to go lower, but it can't because, well, the price moves down. Someone that we call the big guy, that is the set of 10 institutions, 10 top 10 institutions that manage the 70 or even more percent of the volume in the markets, are buying. So that's why the price is moving down, because there should be a lot of sellers, but the buyers are aggressively buying, and that's why the price is not selling off strongly. But if, on the other hand, if nobody's buying, and we have the same setup here, and nobody's buying, the price is going to move like this here. And that's why buying here or trying to do something with a fast corrective wave is not a good idea, because we don't have the big guy in our direction. We will be actually trading against the big guy. So when you have a fast move during the corrective wave, the price is likely to continue. And you are wasting your time and you are wasting your money trying to do something when the price is like that. So that's of course an important aspect of this process. Let's stop there for a second and let's go here for the Aussie dollar. You can apply these concepts on any market. So let's have an example here. So look, traders, here we're seeing an impulse in the live market. So I'm going to add the labels. You can apply this on any time frame, but as I mentioned at the beginning of this class, we always start from a higher time frame to have a complete wave count. But in order to explain the concept of the impulse and the corrective, I'm just going to label this impulse here. Wave 1, wave 2. We're going to go back here to talk about the wave 2. Then we can have here the wave 3. Here we can expect the wave 4 and the wave 5. So we will talk about these waves in a second. But let's focus here. So listen, we have our wave 1 complete. Here we can have 1, 2, 3, 4, 5. Wave 1, 2, 3, 4, 5. Here I have a spoiler alert for you, and is that the wave 4 moves inside the wave 1 in this case, and that happens when we are in a leading diagonal wave. Then the second wave starts, and here we have the corrective wave. So as I mentioned, one of the key characteristics of the corrective wave is that it needs to be slow. So here we have fast, here we have the price moving a leg up, and here will be your first entry point. Right here, you have an ABC, and you can buy here. This is your first entry point. So if we go long here at this point, we have two options. One, that is the one that I like more, leaving a small stop loss. And if it takes us out, like in this case, sometimes the corrective wave becomes a little bit more complex. We trigger the next entry that will be here. So that's one option. Other traders like to trade with bigger stop loss. This is a day trade in this case, because the stop loss on the original one will be around 63.98, and here having the stop loss here is a two-point stop loss, which is nothing, right? Or we can leave the stop loss here in these lower time frames. At the 63.92, we will be working with a 6-point stop loss on the Aussie, right? So it depends on how you feel, on if you like the 2 or 3 point stop loss. You can go with that one, and knowing that if the price makes the low here, you can trigger again, right? So that's the strategy for trading with price action. Then after the second wave, when the wave 2 is over, we're expecting the wave 3. So the wave 3 starts, and we have here 1, 2, 1, 2, 3, an extension, 4, 5, 4, 5. So there sometimes we can have extensions, and more than extensions are the internal waves of wave 3. So let's add the internal wave count here. So here inside we will have 1, 2, 3, 4, 5. Right, so there we have our 5 wave sequence inside of 3 on this same time frame, because usually that's another common mistake that sometimes traders are a little bit confused about, and is that they need to change time frames to see different degrees, and actually that's not true. We can label the same on the same chart different degrees, no problem with that, because the degrees are not related with the time frame. The degrees are visible in the chart. So if you can see them here, it's fine. 4, 5. Right? And this will be a lower degree. You can use colors. There we go. Let's fix this one a little bit here. And there we have our 3, 4, and 5 sequence. So one of the key benefits of using the Elliott Wave theory is that we know where we are. So, of course, one of the best trades is the trade after the second wave, because after the second wave, we are looking for the wave 3. The wave 3 is the strongest wave of the cycle, of the impulse. The third wave is a fast move that you're going to have a risk reward of 1 to 3, 1 to 4, 1 to 5 during that process. Then comes the wave 4. The wave 4 will be coming here after the wave 3. So one characteristic of wave 4 is that the wave 4 is not likely to be extremely deep. Sometimes, in case that you have a deep wave 4, let's suppose that you're here and you start seeing something like this, don't try to trade the wave 4, because fast corrective waves are not high probability setups. Remember, always when you are trading a corrective wave, look for a slow price. If you have fast price, don't trade it. Like, for example, this wave 4 here, the wave 4 green, this one here, is too fast, the last leg. So this one is not a good one. This one, the second wave here, is great. We can see the difference because one is slow and the other one is fast. We don't want to go against fast price, never, never, never. So the next step in the process, traders, now that we see the completion of the wave 3, is waiting for a slow move down, let's say like an ABC formation here, something like that, an ABC where we can start following the move up after that. And once we have the slow move, we can follow the move up. Of course, in this case, we are sort of scalping or day trading. If you like to apply these concepts on higher time frames, will be the same. So let's move to the hourly chart, and I can show you what we are working on the Aussie. So that's what is so fantastic of the Elliott Wave theory, that you can trade on any time frame that you like. Lower time frames, smaller stops, faster trades, more trades. Higher time frames, bigger stops in terms of points, but you will get also bigger trades in terms of points in profits. So of course, whatever you like, it depends on your personality, it depends on your time. If you have another job, you can't be in front of the screen doing a scalping the entire day. Well, not the entire day, that's too much, 2 or 3 hours a day. But of course, you can swing trade. So look, the bigger picture analysis on the Aussie is that this will be a second wave. All this is going to be a wave 1, and this is a second wave ABC. Right? So this will be a wave 1. Now you can start seeing the internal waves, right? 1, 2, 3, 4, 5. And this is the 3-wave sequence, ABC. So on the higher time frame traders, on the Aussie dollar, the plan is getting back to the previous high. So after the ABC, we will be looking for the price to reach this high again. And once the price builds this leg up to the previous high, that's where the magic is going to happen. Because right there at the previous high is the target. That's going to be the target on the hourly chart. And we can trigger the trade by going to lower time frames. We can trigger the trade from this time frame. So in this case, we are looking in our membership, finding the bottom of this second wave to go long. We have one rejection that we didn't consider a good entry because the price was just in the third wave of 5. Remember, fractal markets. And this area we consider as a good entry point. So we can start mixing up different parts of the degree, and around this concept we can build a lot of strategies. Now we can go to lower time frames. We can go back to the 1 minute chart, let's say, and we can plan the entry. So look, the wave 4 is happening, right? When you are starting your career, when you are trying to be consistent, always start following the trend. Always. Then, when you are confident about following the trend, then you can start, if you like, is optional, finding counter-trend trades, trades against the trend. But if you are not successful yet following the trend, don't try to go against the trend because it's more difficult. So your job at the beginning is following the corrective waves. That's your job. Following the corrective waves means looking for the end of the corrective wave, right? That's your job. So here in these process traders, when the market structure will be something like this, right? You are going to buy the lows, buy the lows, buy the lows, sell the highs, but sell the highs for closing your trades if you are starting. If you have more experience and you already demonstrate to be making money by buying the lows in a bull trend, or selling the highs in a bear trend, if you're already successful by doing that exercise and you like also to trade the other side, okay, go ahead. But start with buying the lows. Now, in this particular case, what will be the plan? Buying the lows, following the trend. So what are we going to plan here? Well, we need to have a 3-wave sequence. This is just the first leg. We need to have a stop in action that we call it the B wave, and then a C leg down. That's something that we are going to wait to clearly see in front of us. Like this example here that we check, or like this example here, ABC. Right? Always we need to have an ABC. If the price departs for the wave 5 before, oh, what a shame. We didn't trigger. That's fine. We need to plan the trade and trade the plan. So when we have the completion of the ABC, then we just follow the trade, or we follow the plan to get here to the previous high. And then when the 5-wave sequence is complete, that will be a higher degree wave 1, and we can expect the ABC. Right? That's the process traders. Let's have a look at another instrument. Let me see, now that the stock market just opened, remember that we can apply these concepts on any instrument. So give me a second to check what is interesting today at the opening, to see what we can trade, because everything is so expensive, but we can make the exercise on a lower time frame. Okay, probably Alibaba, BABA. It's in a corrective wave, so let's see if we can find a trade here on these lower time frames, because it's in the corrective mode. And if we zoom out a little the chart, like on a 5-minute chart, we can see that this seems to be building a corrective wave. Right? If we come here with the market structure on a 5-minute chart, this will be the wave 1, this will be the wave 2, this is the wave 3, this is the wave 4, and this is the wave 5. Let's say that this is a wave 1, or any number, because we are here on the lower time frame, so it's fine. And this will be the wave 2 that is in progress. So we already have our first leg down, our second leg, and we are in the third leg down. Right? So we need to have the price to come down here. And if the price comes here, and can continue lower and it starts showing signals of reversals, we can buy it and we can target the previous high. This will be a day trade on Alibaba. And you can start playing around with these concepts. Keep it simple. 1, 2, 3, 4, 5. Start finding your wave count. So let's zoom in here. The price is moving fast to the downside. And we will be waiting for the low. Let me check if there is something else here, something that is like even more ready for the setup, that we can make the example like a. Okay, Bank of America. Let's have a look. I think Bank of America is ready for the buy trade on the lower time frame. So let's go here. Bank of America. Great. So, okay, so look, really quick analysis here. So we have this as the wave 1, let's say, and this is a wave 2, right? We have here a first zigzag. This could be a connector wave, and here we have a second zigzag. There are combinations. There are single zigzags and double zigzags. Don't worry for that now. The price builds what it seems to be a wave 1 and a wave 2. So here we already have permission, either from the end of 2 or from the top of 1 at the most, that's the last point of entry, to buy it. The target is the previous high. So right now, let's suppose that we are in the trade and it's a buy trade, and the stop loss, let's suppose that we trigger here at the opening, whatever, somewhere there, or the actual price, whatever, it doesn't matter, the stop loss is here, right? And the target is the previous high. So this is a risk-reward ratio 2.68. 2.68. So I risk 1 to make almost 3. It's a good deal. It's a pretty good deal. So this corrective wave here is showing the potential because it's moving down slowly. Right? If we want to execute the trade even better, we could be on the lower time frames. But of course, that's a setup from yesterday. Let's have a look while the price moves a little bit more. On the 1 minute chart, we can see the 5 wave sequence for the wave 1. So we can say that this could be our wave 1 here, the wave 2, the wave 3, 4, and 5. Then comes the corrective wave. Here is too fast, so we have to wait. Here, the price slows down, and this part is slow. Because we have the previous low on the left, and we believe that this is the wave 1 and this is the wave 2, we have the green light, let's say, to buy it at this rejection. So this will be the first entry point. Or when the price crosses the wave 1, as we are seeing today the setup. If we trigger here the trade, if we go long here, the stop loss is going to be under this low. If we went long here, the stop loss is going to be under this low. Right? And what we will be expecting here is the wave 3. Make sense? So you can see that we can apply this concept on any market. Let's have a look at another market. Let's go back to the Aussie. Let's see how the Aussie is moving while we were checking the stocks. Great. You see, so the wave 4 finished. I don't see a good trade here because the price was moving down too fast. But you can start, of course, adding your opinion and you can start adding your experience. For me, for my personal interpretation, I don't like this leg down because it's too fast. But a trader that likes to trade with candlestick patterns will say, but why? Here we have a hammer. And the hammer is telling that there is a lot of demand at the low. And it's also the previous wave 4 area. and I'm looking for the end of the wave 4, so I have to trigger. So for a trader, this could be the dream trade. In my case, I don't like it because it's too fast. And of course, with experience, you're going to start building these setups. Let's have a look at another one. But the important part here, the important aspect about this, the beauty of this way of understanding the market structures, is that we have a plan. We can quickly understand where in the cycle we are at, and how we can manage the trades. And you can apply this concept on any market. Let's have a look at another one. Let's have a look at the euro dollar. Let's see how the euro dollar is moving today. We are in a bullish trade on the euro dollar. Yesterday we went long in our membership. So look, we have a leg down, ABC. Simple, right? You're starting to see the setups. Here is the rejection. So we triggered at the 106.80 area. When the price cleared the wave 1 and the wave 2, we started the buy trade here. The price comes up during the session yesterday, nicely enough, to 1-to-1 risk-reward ratio. Right there, we booked some partial profits. And of course, then if you sign up in the Elliott Wave Street membership, or if you are already in this Elliott Wave Street membership, you already know that how to manage the trade. But of course, it's not the subject of this class. And then we can say that this is the wave 1 and this is the wave 2. So there we have our ABC. And here we have again 1 and probably a small 2, and we're looking for a big 3 back to the previous high. So when we have this market structure, the next step is, if we need to trade on lower time frames, we can move to lower time frames. So let's do it. Let's have a look at the example here on the euro. So the euro is having the 5-wave sequence, right? 1, 2, 3, 4, and 5. And we already have a 3-wave sequence, A, B, C. As I mentioned before, if you are completely new to the Elliott Wave theory, don't worry. This is something that you are going to master really fast. But sometimes we have a single zigzag, and that's fine. If we like it, we can buy it. And sometimes we are going to have something called a double zigzag, and we label W, X, Y, where W is the first zigzag, Y is the connector wave, and then we have an ABC for the second zigzag. Sometimes you're going to face this type of corrective, but don't worry, it's actually pretty simple. So right here, if we consider that this is good enough, we can have the buy trade. We can have the bullish trade if we are scalping the 1-minute chart to target the previous high. If we are looking for a bigger picture trade, we can wait for a better discount. We can wait for something better to have a better discount and follow the trend, right? So of course, it's a matter of practice. It's a matter of looking for the end of each cycle. Let's go back to the Aussie. Great, is hitting the target, right? Right now is hitting that target. In case that we went long because the hammer, whatever, is hitting the target. If we didn't like it, we are still waiting, right? And here we have wave 1, we have wave 2, we have wave 3. We will be looking for 4 and 5 on the lower time frame. This is gonna complete a wave 1 of higher degree. So at this area, now we have to start being extremely, extremely careful, because the next step in the process will be having an ABC, a bigger ABC. So as I mentioned, following these trades, like this one or even this one, is easier. the counter the trend trader right now is trying to sell, and that trader is gonna start having some stops, and you can make the exercise on a demo account while you define your strategy. But of course, this high is the top of 3, so one of the counter the trend techniques is to look for the price to return. So let's suppose that price finish here, it's wave 3, 4, 5, and returns. So this would be the sell trade for the counter the trend trader. Or even more aggressive, to sell here after the 3, 4, 5 sequence. And in that way, the trader can start looking for the sell trade. And when the price finishes the cycle and starts selling, we can start looking into the ABC, into the next degree of this setup, right? So it's a process. Let's have a look at another one that is pretty interesting for selling right now, the dollar cat. It's a little bit late. Okay, no problem. 5-minute chart, hourly chart. Let me show you what we are doing here. I was looking for this trade. Okay, no problem. So the target is this low here, 136.40 area on the higher time frame. Yes, we can say A, B, C. That's fine. Now, as you can see, the price finish, it's a wave 2, wave 4, any corrective wave that you want to call this cycle. And now is starting the wave 3 to the downside. The target is the previous low. So let's have a look at the lower time frames to see how the setup looks like, because this is an example of a bearish impulse. Oh yeah, but it's too late to trigger right now. What a shame. Okay, so here we have the first leg down, wave 1. Then look at this beautiful 3-wave sequence. This one is called the flat. The flat pattern is also an ABC, A, B, and C, but the difference here is that the B wave is gonna move most of the times 100% the wave A, sometimes a little bit more, sometimes a little bit less, but it's going to be between 90% of wave A and 138.2% of wave A. The price then moves up fast, so that's the only tricky part that I don't like too much about this setup, is too fast, but when it returns here, this one is good. Or this one, because that will be another wave 1 and 2. We start finding the setup, or if we don't like those corrective waves, we can sell below the wave 1. Because we are on a lower time frame. Never try to sell below or above the wave 1 when you are on the hourly chart or the 15-minute chart on a higher time frame. You can only perform these actions when you are on lower time frames, like selling the end of the wave of the previous impulse. This is only permitted for scalping or for trying to trigger the trade faster. But never try to do this on the hourly chart because your stop is going to be huge. Of course, let's suppose that I sell here at the 137.80 and I leave a protective stop loss at the 138.10. So this is a 30-point stop loss, which is fine. But of course, if the stop loss is 100 points, it doesn't have any sense, right? So that's the dollar cat. Let's see what else do we have here interesting. Okay, so let's go back to the Aussie. Let's see how the Aussie is acting at the high. Okay, so we know that at this area, the Aussie is gonna finish soon its wave 1 of higher degree. So clearly, this wave 1 of the higher degree is gonna give us the advantage of knowing where we are. And here, traders, is where it's likely to start the second wave. So this is wave 1. Here, the second wave will be something like an ABC. And once we have the ABC, here is where we can start looking for the next entry point to capture the bigger move. This will be on a 5-minute chart, on the 15-minute chart, of course, as well. But on lower time frames, the scalper, let's go to a 15-second chart. Here, the scalper is looking for the end of 5. So look, we have 1, we have 2, we have 3, we have 4, and this is the wave 5. That will be in progress right here. So when we have the completion, traders, of this 5-wave sequence and the rejection and the reversal here, that will be the most aggressive counter the trend trade that you can make. A little bit more conservative here. After the 5-wave sequence, you have the price moving down here. And the most conservative one, counter the trend, counter the impulse, and against the impulse, will be here after a 3-wave sequence. That will be considered a trend trade. But again, when you are in that process of learning, when you are in that process of finding everything out, it's key to start with your it's key to start with following the trend. It's key to start mastering following the trend. And once you are done with that part, you can start working the other way. Make sense? Yeah, fantastic, traders. All right. Traders, so that's our Elliott Wave Basics webinar. I'm going to post the recording later today in the website, so you can check the concepts again. And also, if you don't have your Elliott Wave Street membership active yet, we have a fantastic membership where you can get the daily wave counts, the daily trading plans, the daily reports, a lot of value in the ElliottWaveStreet.com membership. Come here, check the plans. If you are a new client, you can start your trial for 1 month to try this out. Pick your plan and sign up now, and you will get immediate access to the Elliott Wave Street membership. Traders, thank you very much for being here in this webinar. I'll see you inside the membership. Have a fantastic rest of your day. Take care. Bye-bye.